This is Bazaar Morning Call, broadcasting live from the CNBC TV 18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV 18 Motilal Oswal studios, coming out of a weekend and heading into a fresh new week. So much happening. So much was expected over the weekend. Some of it happened, but things are a little settled, which is good news as we begin this Monday morning. I'm Prashant. With me, my colleague Sonia and Nigel. Guys, say good morning.
Hi, good morning. Morning, Nigel.
Morning.
Well, I think it's escalating geopolitical tensions that are top of everyone's mind, right?
Yep.
What's happening with Iran and Israel and the kind of repercussions it would have on the market. For now, the sentiment will definitely get hit, but time will tell whether the dips get bought.
Well, we'll be analyzing the financial impact all through the day, but for the good of humanity, just want all this, escalation to turn into de-escalation, and hopefully a better sense prevails and we have peace on this earth.
Well, that's a nice philosophical note to start the week. And
we'll do the numbers during the day, but, hard
No, absolutely. And why not, right? That, of course, is that's what everyone wants to see. Now, let's just quickly take a look at the escalation, right? So there was a flare-up in the Middle East. That's what markets were expecting, some sort of retaliation. It all started, remember, about a week and a half ago when Israel allegedly attacked Iran's embassy in Damascus, and a senior Iranian military official was killed. So markets since then was expecting Iran to actually launch a counteroffensive. And it happened over the weekend. So Iran launched hundreds of drones as well as cruise missiles at Israel. Israel, by its own admission and its allies in the region, they intercepted most of these missiles, and Israel says the damage was very, very minimal. And comments then from Iran suggests that this is settled now. They basically said that we had to retaliate. Retaliation is done. And unless and until we get an attack now from Israel, we will not escalate this. So, and I think that is where things are at this point in time. There were also comments from Israel, but via the US officials saying that Israeli officials have told them that Israel is not looking at a larger response to what Iran has done. So it does look like, as we start another fresh week for financial markets, that things are, it's still on the edge a little bit, but maybe a little cooler as compared to where things were on Saturday or Sunday. Things are a little bit cooler, and it's not as bad, at least right now. Now, as I said, markets were bracing for a sort of reaction, right? So US markets de-risked going into the weekend, bracing for an escalation. And what happened? VIX, for example, the CBOE VIX had a 6-month high. Actually, it went up all the way to about 19.5 and then cooled off a little bit from there. US bonds rallied about 5 to 7 basis points. Yields fell. You had equity markets which sold off. So the S&P was down about 1.5%. The Nasdaq was down about 1.6%. And oil prices, so these are sharp reactions which we saw. But this is all sort of going into the weekend in anticipation of the action that we can expect over the weekend. And oil, of course, stays north of $90 a barrel. I would still say markets are, what can kind of trigger a bit of an upheaval even from here is, of course, how Israel reacts. And that is, of course, something which we'll have to wait and watch. Hopefully, it will not be something large, and, this issue is kind of settled from both sides now, for the time being at least, and markets will move on. So that's where we are at with regards to this geopolitical issue. And you can look at sort of Asia is down, etc., but there's no big move on, oil or some of the other sort of indicators, typical indicators, or look at the Dow futures or the S&P futures, etc. There's nothing very large after what happened on Friday and over the weekend as well. Here in India, the Nifty closed below hourly averages on Friday, and we closed below the 40-hourly exponential moving average. Supports now stand at 22,270, which is the 20-day moving average, and 22,200, which is the 40-day exponential moving average. Now, even without all of these geopolitical tensions, etc., we were saying this last week that maybe for the next month and a half, in the near term, things could be a little sideways and we could actually drift a little lower. And I think this kind of ties in with what we are seeing globally as well. So the 20-day, which is around the roughly 22,300, just to round it off on the upper end, remains the pivotal point, which let's see if the Nifty gets to it. And if it gets to it, if it gets defended, Resistance, of course, is the 22,275 mark, which is actually coming in. Now, for the Nifty Bank, that has not broken the hourly averages. The Nifty Bank is still, by the way, above the 40 hourly average, which is 48,492. So that is the first level which the Nifty Bank needs to defend. If that goes, the support again for the Bank Nifty comes in at the 20-day moving average, which is 47,393. And on the upside, resistance stands at 49,057. So, just squaring off the levels and the numbers, the GIFT Nifty will come up on your screen. It's indicating a 130-odd point lower start. It's not large. I mean, it's not a big, massive fall out of which you really need to rush in and buy that dip. A little larger, and then risk reward becomes a little more effective and a little more lucrative, which is not the case as we start with just about a 100-odd point cut today morning. Sonia.
Oh, absolutely. And something had to give, right? The market was rallying and rallying hard. So there was some excuse for a sell-off that the market was looking for. Yeah. If you notice in the last couple of days as well, the Nifty has actually come off about 200 points from its highs, from its record highs that we saw. So, of course, geopolitical tensions is something that's going to keep a lid on the market's gains in the very near term, especially today. The important question we're asking is whether the dips get bought and whether that's the prudent thing to do. Now, we have to see how this entire geopolitical issue unfolds. It could be a binary event. But the dips could get bought as well, because that has been the texture of this market for many days. Having said that, the next couple of days would be prudent to be a bit cautious as we head into some of these big events. Remember, a lot of the internals, global internals, are not looking good. Crude prices are at $90 a barrel. US 10-year yield continues to stay high at about 4.54%. The Dow had a big fall on Friday as well, almost 500 points gone. The S&P 500 saw its worst days in January because inflation woes are something that continue. In fact, the inflation data was higher than what Wall Street estimated, so maybe the rate cuts could be pushed out a little bit more. So all of that put together is something that has not been taken well by the street. There was large selling by FIs in our own market as well. FIs sold almost 8,000 crores in the cash markets on Friday. So yes, it's better to be cautious in the very near term. Having said that, some of the internals of our own market are not too bad. So if you look at TCS's numbers, for example, the margins are at a 3-year high. There were record deal wins in Q4, largely more positives than negatives in TCS's earnings, and that's something that the street would definitely like. A lot of results to watch this week. You have Infosys that comes out on the 18th. You have Bajaj Auto on 18th as well. There's HDFC Bank on 20th. On 18th, you also have the Vodafone FPO that opens. So there's plenty of corporate action that we're going to be tracking. But for now, for the market, the start is going to be weak. It could be a bit protracted, the kind of, sell-off that we're seeing purely because of the geopolitical tensions and which way it goes. And the market was, I guess, looking for an excuse to correct as well, and they found that excuse. So a little bit of caution, perhaps, is the need of the hour.
Well, that's right. So if I look at Friday's trading session, though, and if you look at the intraday chart, I think the bulls out here were sensing that maybe there's going to be some bad news coming over the weekend, because we ended virtually at the low point of the day with a cut of around 230 points out, and the final tick was at the day's low. Now, two problems are faced ahead of us. One, on the global front, that is, domestically, everything's looking good. One is, what's the Fed going to do next? Because the data points coming out of the Fed, well, a little bit, muddled, so to call it. And that's why, in fact, that rate cuts now are being pushed down. So that's point number one. Geopolitical issues, affects everything. Gold prices moving up, crude prices moving up, base metal prices moving up. So those are the key factors that are weighing on our markets. History suggests, though, that geopolitical tensions have been a good entry opportunity. Will it play like that? We've seen it numerous times in the past, and it's played out in favor of the bulls. So let's see how this one goes as well. In terms of levels that I'm looking at, well, the crucial support is around 22,200. If you're an aggressive trader and you have that kind of appetite, and if you want to buy, well, the 22,200 mark becomes extremely important. And I'll tell you why. Because the 22,200 put has the highest open interest on the put side. And also the 20 DMA comes in that vicinity of around 22,270 approximately. So both those two data points should come up for you on the screen. Well, what do the FIs do? Well, they unwound some long positions in Friday's trading session. They continue to remain net long, though, with 56% of their positions on the long side. And I was making this point on Friday morning. I like a market that's a little bit net short. I don't like an overtly net long market. And, the net long contracts have come down from around 50,000 contracts. It's come down to around 35,000 contracts, but they continue to remain net long on the index. And just a few days ago, they were net short. So there's been a big swing factor out there. Still 33,000 contracts on the long side. The index that I'll be watching today is the metal index, because there have been some sanctions that have been put by UK as well as United States on Russia's metals. So that could provide a near-term fillip, because ultimately Russia's supply could make its way to other markets like China. China has been a big buyer of Russia's metal as well. But in the near term, we'll keep an eye out on the metal index because there could be a short-term pop given that there are restrictions that are put in place. So 130-point downtrade to kickstart trade. If you have the aggressive appetite, then the 22,200 becomes a line in sand for you, as I told you earlier.
All right, thanks a lot for that. Well, there's plenty of opinion coming through this morning, so let's get straight to it. On the equities front, first up, we have a comment coming in from Rhythm Desai of Morgan Stanley, who says that in temporal terms, this bull market is aging, but it's still young in terms of returns, especially because we see some distance for the earnings cycle to go, driven by some surprising changes underway in India. He says, therefore, this is set to be India's longest and best bull market ever, so stay invested.
All right, Amit Sachdeva, HSBC thinks that India is positioned for another good year. Consolidation, if any, he says, is likely to be shallow and create buying opportunities. He prefers auto, healthcare, energy, retailers, real estate, industrials and telecoms. Amit says risk-on plays include IT services, banks and chemicals as well.
Okay, let's also try and get you some money market views for the morning. B. Prasanna of ICICI Bank says that persistently stronger jobs and hotter inflation data in the US strengthened the dollar, which gained further momentum from safe haven buying of the dollar owing to heightened geopolitical risks. He says higher crude prices may trigger risk-off, affecting the EM flows negatively. He adds the rupee could be under pressure in the near term due to higher crude, geopolitical risks and a stronger dollar. However, he says the RBI will likely protect the rupee from a sharp depreciation and expects the rupee to trade in a range of 83.40 to 83.80 this week.
On bonds, B. Prasanna says that global bond yields are shot up post strong labor and inflation data with large rate cut expectations getting priced out, particularly in the US. He says risk-off sentiment emanating out of flaring up of tensions in West Asia, however, led to some retracement of this move. He says local yields have also moved higher but remain contained given strong investor demand and benign supply. He expects range-bound movement with a 10-year benchmark bond yield trading between 7.1 and 7.2%.
Well, we have a lot of stock-specific action to track for you. We'll get to that in just a bit in our special Top 10 segment. We're looking at TCS, Patanjali Foods, Senco Gold, Anand Rathi Wealth, Aster DM, Granules, ISMT, Varun Beverages, Ami Organics, and metals will be on our radar as well. So most of them will be reacting to positive news flow. Let's see how it goes. Gift Nifty suggesting a downtake. So let's see how many stocks open up in the red.